You are not broke because you make too little money. Most people stay broke because they use the wrong strategy for the decade they're living in. 10 years ago, you could throw money into almost any index fund and look smart. Cheap money flooded the market, tech exploded, everything went up. But today is different. Artificial intelligence is changing entire industries. Energy demand is surging because of data centers. Cybersecurity has become mandatory, and millions of investors are still stuck chasing outdated dividend plays that barely beat inflation. That's why some people will quietly build life-changing wealth over the next 10 years, while others work another 30 years and wonder what happened. The truth is, making $4,000 a month from investments is absolutely possible today, but not with random meme stocks, not with gambling, and definitely not by chasing those ridiculous 15% dividend traps all over YouTube. The strategy that actually works now is simpler than most people think. You combine three things: strong broad market compounding, AI-driven growth sectors that are still expanding, reliable cash flow investments that can eventually pay you monthly income. That combination matters because relying only on dividends is too slow early on. But relying only on growth can leave you rich on paper with no cash flow. The investors building real wealth today are mixing both, and that's exactly what we're going to do. This strategy is built for the modern market, not 2010 or 2020, right now. Because if you understand where money is flowing over the next decade, you stop investing emotionally and start investing strategically. The first thing you need to understand is this: your goal is not to get rich fast. Your goal is to own assets that become more valuable while they keep paying you. That's how wealth is built quietly. Look at the biggest trends happening right now. Artificial intelligence is forcing companies to spend billions on infrastructure. Data centers need insane amounts of electricity. That's why utilities and energy infrastructure are becoming growth industries again. Cybersecurity is exploding because every company is now vulnerable to AI-powered attacks. Analysts expect cybersecurity demand to keep growing rapidly as businesses move deeper into cloud systems and AI automation. At the same time, broad market ETFs like the S&P 500 and NASDAQ funds continue dominating long-term wealth creation because the largest companies in America still control global innovation. And here's the important part most people miss: the richest investors are not trying to predict the next tiny stock that could 100 times. They buy the sectors where the world is already heading. That's why this strategy starts with a core foundation, not individual stocks. ETFs, because most people dramatically overestimate their ability to pick winning companies for 20 years straight. An ETF removes that problem. It automatically spreads your money across dozens or hundreds of companies. One company can fail and your portfolio still survives. That's real investing. So here's the modern portfolio structure that actually makes sense today. The foundation is the S&P 500, something like VOO or IVV. Why? Because every major economic cycle eventually rewards the strongest businesses in America. The S&P 500 constantly removes weak companies and replaces them with stronger ones. That means the index evolves with the economy automatically. 20 years ago, it was oil and banks. Today, it's AI, cloud computing, semiconductors, and software. The index adapts without you doing anything. That's why millions of investors continue building wealth through simple index investing. But here's where modern investing changes. In previous decades, you could stop there, since AI is creating a massive acceleration cycle, and if you completely ignore growth, you may build income too slowly. That's why the second layer of the portfolio focuses on high-quality growth ETFs, not speculative garbage. Real companies dominating previous systems and digital automation. Funds like QQQ or SCHG have become powerful because they heavily weight companies driving modern technology. Over the past decade, QQQ massively outperformed the general market because the world became more digital. And honestly, this trend probably isn't ending soon. AI is still early. Most businesses have barely integrated it. That means the companies selling chips, cloud computing, networking, cybersecurity, and power infrastructure may continue growing for years. But this is where most investors mess up. They go all in on growth. That works during bull markets. Then a recession hits, tech crashes 40%, and panic takes over. That's why the third layer matters. Dividend growth. Not ultra-high yield traps, real dividend growth. There's a huge difference. A stock paying 12% often means the market expects problems. A company paying 2% but increasing dividends 12% every year can become a monster over time. That's why ETFs like SCHD became so popular. They focus on financially strong companies with healthy cash flow and long-term dividend growth instead of reckless yields. And this is important. A lot of YouTube channels push covered call ETFs like QYLD or XYLD because the yields look exciting. But many of them sacrifice long-term growth for short-term income. Even analysts today warn that blindly chasing covered call income can become a trap for younger investors trying to build wealth. That doesn't mean they're useless, it just means timing matters. Covered call ETFs work better later in the journey when your portfolio is already large and your goal shifts toward monthly cash flow instead of maximum growth. That changes everything, because early wealth building is about compounding, not extracting income too soon. Think about it like planting a tree. If you keep cutting branches off while it's small, it never reaches full size. The investors who become financially free fastest usually focus heavily on growth during the accumulation phase, then slowly rotate toward income later. That's the modern strategy. And honestly, it's far more realistic than trying to live off dividends with a tiny account. Now let's talk real numbers, because this is where people finally understand how powerful compounding actually is. Let's say someone invests $500 a month. Not $5,000, just $500. That's roughly the cost of eating out constantly, financing a luxury car you don't need, or making random impulse purchases every week. At first, progress feels painfully slow. Year 1 feels meaningless. Year 2 barely changes your life. Most people quit here. But somewhere around years 8 through 12, the snowball changes. Your investments start making more money than your contributions. That's also why Charlie Munger said the first $100,000 is the hardest, because at the beginning you are carrying the portfolio. Now here's what a realistic modern portfolio could actually look like today. 40% S&P 500 ETF like VOO, 25% growth ETF like QQQM or SCHG, 20% dividend growth ETF like SCHD, 10% infrastructure and utilities exposure, 5% high-risk asymmetric growth. That last 5% is important. This is where you can take calculated shots. Maybe AI infrastructure, maybe cybersecurity, maybe digital energy systems, maybe robotics. Systems the world increasingly cannot function without. And here's something most people never hear. The easiest way to make $4,000 a month from investments is not finding magical returns. Most investors obsess over finding the perfect ETF while ignoring the real engine, cash flow. A person investing $2,000 monthly into simple index funds will usually outperform someone investing $200 monthly into perfect stocks. That's why wealthy people focus so heavily on increasing income early, because more invested capital means compounding accelerates dramatically. The math becomes unfair after enough time. And this is exactly why so many financially successful people eventually seem to get rich very quickly. You're not seeing the first decade. You're seeing compound growth after years of discipline. That's the part social media hides. The boring years, the sacrifice, the consistency. Meanwhile, disciplined investors will keep buying, month after month, year after year, because real wealth usually looks boring while it's being built, until suddenly, it isn't.